Around 10:42 a.m. on February 12, 2026, one trader's phone kept buzzing without stop. Bitcoin had just plunged 7% in a matter of hours. By noon, his $120,000 leveraged position was completely wiped out. There was no hack, no scandal, just pure mechanical liquidation. To millions of retail traders, that day felt sudden, brutal, almost random. But was it truly random? Who really decides when money flows in and when it suddenly stops? Who writes the rules that let some walk away unscathed while others are destroyed first? And when the whole structure cracks, who ultimately pays the price? Most people only saw the surface. Bitcoin broke below $67,000 during U.S. trading hours and slid towards $65,000. Ether and altcoins were crushed even harder. At the exact same moment, the Nasdaq dropped 2%. That detail matters. Crypto no longer moves in isolation. When stocks sneeze, crypto catches the flu, and it catches it faster. The reason is simple. The same large pools of capital feed both markets. It all looked like just another bad day, a classic risk-off mood. But beneath the surface, something far more mechanical was unfolding. Order books were already paper-thin. Leverage had piled sky-high after months of relentless optimism. Long positions dominated everywhere. Then, a single event triggered the collapse, and the dominoes fell, one after another. What lit the fuse? The U.S. jobs report released the day before, on February 11th. Nonfarm payrolls came in at plus 130,000, stronger than the expected range of 55,000 to 70,000. Unemployment ticked down slightly to 4.3%. Markets quickly recalculated. Rate cuts would be delayed further. Treasury yields spiked. That was it. No crypto-specific scandal, no exchange failure, just a routine macro repricing. Yet in a world built on borrowed money, higher for longer interest rates become a sledgehammer. Crypto had loaded up on leverage, betting that cheap money would last forever. Futures open interest had exploded. Perpetual contracts were stacked to the ceiling. Margin levels were stretched to breaking point. When the cost of borrowing rises, that bet stops working. And when it stops working, everything unwinds at lightning speed. Automated sells fire. Liquidations cascade. Billions of dollars vanish in days. Estimates put total crypto liquidations in the $2 to $4 billion range, with Bitcoin taking the heaviest hit. Forced selling breeds more forced selling. The key point? This shock didn't come from outside the system. It was the system's built-in fragility finally showing its face. Now look at who actually felt the pain and who didn't. Retail traders were liquidated in seconds. Exchanges kept running smoothly. Market makers were hedged and survived. Institutions holding ETF positions had deeper pockets to absorb the drawdown. The system itself never collapsed. It simply redistributed the damage downward. Who had seen the leverage mountain building? Exchanges monitoring open interest, clearinghouses, regulators watching the data feeds. Who benefited as long as leverage stayed elevated? The entire ecosystem. Trading fees, volatility premiums, derivatives revenue. When leverage inflates, everyone profits. When it implodes, retail absorbs the first and hardest blow. And here is the part most people overlook. Crypto was once marketed as digital gold, an escape from central banks and traditional finance. But February 12th proved the opposite. When money becomes scarce, crypto behaves exactly like a turbocharged tech stock. High beta, risk on in good times, risk off in bad. Its fate is tightly chained to macro liquidity, not to any ideology. Nearly a century ago, Keynes described liquidity preference. When fear rises, people hoard safety. In 2026, that ancient instinct returned. Capital fled speculation, not because anyone hated crypto, but because the price of money changed, and everything tied to cheap money broke along with it. So was this crash an accident? Or is it precisely what the architecture is designed to reward? Massive leverage in the good times, brutal punishment in the bad. No single person pressed a button, but the Federal Reserve sets the cost of money. The cost of money determines which risks can survive. Risk defines crypto. That hierarchy never disappeared. Even inside Web 3, it was simply recreated within it. Prices have recovered somewhat since then, climbing back towards $68,000 by mid-February. The fear will eventually fade, but the structure remains unchanged. Razor-thin liquidity when it matters most, high leverage waiting to detonate, complete dependence on macro tides. Retail stays forever closest to the edge. The next cascade is already wired in. Because only the ticker symbol has changed, the game itself has not. So the real question isn't, where's the bottom? It's this: who will change the rules before the next one hits even harder?